Hello, and I welcome you to today's weekly market outlook here for Admiral Markets. My name is Klatt. It's the 17th of May, and we want to have a look at what to expect in the upcoming week of trading in the markets, what could drive the markets, what is the current bias, and also interpret the current price action, which has been kind of volatile, let's say, in equity markets especially. If you'd ask me on, I think it was Wednesday. Yeah, sure. Today is Friday. So on Wednesday, I would have said, well, we have a very good chance in the DAX in this case to significantly break below 11,800 points and see some very bearish price action. And then the tide turned aggressively within seconds with Donald Trump saying that he's willing to delay tariffs on automobiles from the Europeans, which resulted in a sharp push higher in the DAX, and we took on serious momentum on the upside yesterday then, and now we are somehow eyeing a crucial a weekly close, and somehow the bulls seem to have the advantage on their side. Well, let's say somehow it depends on what we get to see from Donald Trump today via Twitter. But before we start, as usual, we have to have a look here at the risk disclaimer, and then we'll dig into the details deeper in a few minutes. So trading with financial instruments offered by Admiral Markets carry a high level of risk, which is not suitable for all investors due to their complex nature, and before entering into a client agreement or making a transaction or trade, please make sure that you read the terms and conditions of the service from Admiral Markets. So these were only the first two sentences of the risk disclaimer. The full risk disclaimer can be found on the website admiralmarkets.com. As usual, we want to have a look here at the differentiation now between retail and professional clients. The ESMA decision, which came into effect from August 2018 onwards, there's now a leverage restriction for retail clients with a max of 1 to 30 in Forex majors like Euro USD, for example, Dollar JPY, and 1 to 20 in Forex minors, which is something like GBP CAD, for example, or GBP Australian dollar, just to name two as an example. And but there's also this leverage cap now on CFDs on indices like the DAX 30 for retail clients and also gold. Where is the differentiation now coming into play here between retails and then professionals? Retail clients have this leverage cap, professionals don't, which means professional clients or clients who reclassify as professionals can still trade with a leverage of up to 1 to 500. If certain criteria are met, you can reclassify as a professional. Therefore, feel free to reach out to the website from Admiral and dig into the details here. And if you plan to do that, contact Admiral Markets directly. Very interesting, surely, is the negative balance protection, which is unlimited. If you're a retail client, if you reclassify as a professional, you do not necessarily have such a negative balance protection. But, and this is the interesting thing, when trading with Admiral Markets, you have up to £50,000 according to their policy here. Also, for further info, please feel free to reach out to Admiral Markets directly. Yeah, this is me, the face to the voice, which you're currently listening to. And I'm located in Berlin, in Germany. This is a city where Admiral Markets also has an office, for example. It's the global offering or worldwide presence, let's call it. We'll dig into this a little deeper in a few seconds here. In Germany, we usually refer to Admiral Markets as the so-called DAX expert. So that answers to some extent the question, why Admiral Markets with a typical spread of 0.0 during the main trading hours. Admiral Prime, for example, offers especially for scalpers, this is very interesting, a typical spread of 0.2 with a commission being paid on top. It's also true that Admiral has a very competitive offering when it comes to FX trading. So there are plenty of reasons to have to have a look at Admiral, reach out to the website and dig here into further details than there. So here, One World, global offers, I already mentioned it, the office in Berlin in Germany, but there are also offices in London, for example. There are offices around the globe in Chile, in Australia, for example. There's also the so-called Australian Financial Services license, which Admiral holds there. What this could mean for your trading, feel free to reach out to Admiral here for further information. And to contact Admiral Markets, here are the contact details. the webinar, by the way, this is in regards to the YouTube channel, probably very interesting. If you want to listen to something I will say here within the next minutes, then you want to replay this or see if you understood everything correct, reach out to the YouTube channel from Admiral Markets here. Give them or hit the subscribe button, and there you can also find the recording of this webinar then afterwards. And now let's have a look at our today's agenda here. The questions we want to answer are: what are the key economic events in the coming week of trading? In fact, it's the last week. Oh no, I'm sorry, it's not the last week. It's yeah, but still, it's not a very a packed economic docket we face there. The main drivers and the main interest still and surely lies on the trade war and the developments here. But still, we want to have a look at this, not only at the key economic events, but also at the trade war and what we could get to see there. Then sure, we want to answer the question around the current bias in the FX equity and commodity markets, and then also which trading opportunities may arise. Even though when looking especially at the DAX, for example, you will probably have already seen that there is a very, very choppy price action right now taking place. With a stint lower, so especially when looking at the 5-minute chart, for example, you can see the market really chop and push higher and then lower and then higher and jump for several points in one direction to just be sold again, or the other way around, being sold and then being bought higher again, and the market really jumps. And this is a perfect illustration. Then let's switch back to the hourly chart. That's a perfect example of the thin market environment we're currently in, but also this is probably driven by something which is many are probably not aware of, and it's not a topic yet now anymore. The so-called small expiration today. So usually you have every 3 months, March, June, September, and December, you have a big expiration, so-called triple witching, the options and then also the future, which expires every month. Nevertheless, there's an options expiration, and today is the day, the third Friday of each month, when this options expiration happens, and sometimes you get to see volatility respectively pushes in one or the other direction, which is probably giving a very good explanation of what just happened the 1.5 to 2 hours before, with some very choppy price action. Now the expiration is through, so usually it's 1 p.m. German time then. So this is right now, respectively 10 minutes earlier, and let's now see in which direction we will be pushed. As I already mentioned at the beginning of this webinar, we have seen very interesting price action, which let me come to the conclusion that it's probably a very good idea to be long, especially yesterday, but also today, even though currently the price action doesn't look so promising for the bulls. Yesterday was a very, very strong trend day. You can see it here. There was a sharp squeeze on the upside, which pushed us above a very important level, 12,220 points here. And why is this of importance? Last week we started to paint a bearish picture, and it was a sequence of falling highs and falling lows. And here in the region around 12,220, there was the so-called trend support. I call it support, even though it's a resistance on the upside. It's holding the bearish sequence in play, or it held the bearish sequence in play. Let's put it that way. So there was here this attempt I was already referring to on Wednesday, then to go for another attack of 11,800, and then there was the mentioning from Trump to probably and therefore let's have a look here, to probably plan to delay imposing tariffs on auto imports. There's not mentioned the EU, but this is especially true for the European Union here. And that was then the reason why the DAX within seconds, in fact, shot higher, 100, 150, 200 points. Even though we corrected some of this move then overnight, so overnight from Wednesday to Thursday, we took on bullish momentum again. That was yesterday, and shot higher, broke above 12,220 points. And with that said, the bearish sequence is now not given anymore. So it's definitely a neutral mode minimum. I have to say, I consider the overall advantage being found on the upside. And even if we are now dipping lower and have already failed now to some extent to find a stronger demand against 12,200, 220 points, I'm still on the long side as long as we trade on the hourly chart, as long as we trade above 12,000 points. So, what's now of interest, but this could play out in both directions, is the following. So I've already referred here to the plan to delay those tariffs on auto imports from the European Union. The interesting thing is, so far, we have no tweet from Trump in regards to this topic or mentioning or something. It's just he delays it, and it's a source, but I can't really see, or I can't remember that Trump himself mentioned something like that. So why is this now playing in both directions? First option is that we get to see a denial of that within the next minutes, probably hours. It's like you don't really know when to expect something like that. But what you can already say is Trump is awake. So I've already seen some tweets from his end, which went via Twitter, which means from now on, you can definitely expect tweets to happen and also cause volatility in one or the other direction. So any official statement, let's say, from his end via Twitter, for example, that those imports will be those tariffs on automobile imports from the European Union especially will be delayed, are potentially good for another sharp rise. On the other hand, if there's a denial, well, then we probably get to see a very volatile close of the trading week and another sharp drop lower, which could easily erase all gains being seen here of the last days, especially yesterday, but also erase the gains we have seen then on Wednesday in the afternoon and the drop back below 12,000 points. Currently, I have to say, I think chances are very high that we get to see something which is in favor of such a delay of tariffs here, and this has to do with the fact that here the trade war with China, in fact, escalated over the last days. So after last week, we know last week when we sat together here in this weekly market outlook webinar, we were we were wondering whether there will be a deal struck between the U.S. and China. In fact, Liu He, the vice prime minister from China, and the let's call him the chief negotiator, left without presenting a deal, which made chances very high that there won't be such a deal. And not only that, but on Monday, China announced that they will also raise tariffs on 60 billion of U.S. goods from the 1st of June then. Not only that, but also stopping the purchase of U.S. agricultural products and energy and reducing, for example, Boeing orders, so the airplane producer here. And it also plans to restrict U.S. service trade with China. And this is probably worth mentioning, especially when it comes to looking at the currency markets. The Chinese are, at least it's speculated, that they are currently discussing the possibility of dumping U.S. treasuries, which already resulted in a drop in the US dollar. In fact, the euro can't really take on momentum. The reason for that will be, we will have a look at a little later on, that has especially to do with some comments from the Italian government right now, especially here from Mr. Salvini, who is obviously right before now the election, not the next weekend, but the weekend after. So it's the 25th, 26th of May then, when we have the election here in Europe. And there's, by the way, already some rumors that the right-wing parties have a very good chance of see a very positive result here, which is obviously not positive for the euro. And Salvini himself being critical in regards to the euro, and being known for being very aggressive also when it comes to the politics from Brussels here, already said things like he's willing to break the rules to some extent when it comes to especially the deficit spending in this case. For example, to finance the promises he made during the campaign during the election in Italy in 2018 in May, which already caused some higher volatility. And with this in mind, the euro really can't profit from the current US dollar weakness. The currency to look at here in this respect will be the JPY. But before we come to this, let's come back to the DAX here first. So with this in mind, and with knowing that the Chinese are obviously attacking the US back in regards to tariffs, it becomes obvious that this trade war will most likely continue for quite a while. I mean, there are some mentionings now from Trump that there are still talks going on and he will meet Xi Jinping, especially later in June at the G20 in Osaka in Japan, for example, but still no one's really believing that there will be a deal struck between those two countries. And with this in mind, we have to say, okay, then it only makes sense for the US especially to probably step back and not have a multi-front, let's call it, a multi-front trade war here going, but first focus on China and then probably look for a delay in tariffs being planned on automobiles from the European Union, especially from Germany, for example. The same is true for Japan. The same is also true when it comes to aluminum and steel tariffs, which are a topic in regards to the Canadian, respectively Mexicans. So also the Mexican peso and especially the Canadian dollar, the CAD, are very interesting from this perspective. If these tariffs are lifted, this is usually bullish. In this case, for example, for the CAD, or bearish for dollar CAD. And so that makes definitely sense. And it wouldn't come as a surprise if we get to see some kind of tweet delaying these tariffs then officially, or an official tweet, official statement from Trump into the weekly close, which is something to definitely consider when being positioned in the markets right now, respectively when here looking at the DAX and wondering where my optimism comes from and why I think that the push higher will be seen instead of the drop back below 12,000 points. And this is the main reason, and something to remember, worth remembering here in this context. So it could be that such a push could be initiated within the next hours thanks to such a tweet. And why is it worth mentioning also this topic? It's not only that volatility can be expected, but also keep in mind that volatility can be expected, and then arrange your trading accordingly, manage your trades accordingly. So work with stops, for example, respectively. Take into account that slippage could be a topic. I already mentioned thin market environment in the DAX, which means there are sharp rises and pushes lower within seconds being expected, especially if such a tweet hits the wire. And then it's not only the case that there's such a sharp rise or drop, but also that a thin market environment could result in a worse than usually planned or expected execution of the order, which means slippage, negative slippage, and which is something to take into account in regards to the position size you're taking then. Yeah, so that's it on the DAX. So my overall outlook is definitely positive, also from a technical perspective, at least as long as we have this possibility of a delay of tariffs from the US, and from a technical perspective, as long, in my opinion, as we trade above this blue line. Now it's the daily chart, it's the SMA 200 daily time frame. So as long as we trade above that level, I think there's another and very likely chance, high chance, that we go for another attempt to attack 12,450 points. This is the region around the current daily highs, and if we break above that level, further gains are likely, which could easily push us as high as 12,700, 12,800 points. And yeah, so that's it on the DAX. Nothing more to add here. Now let's have a look then on the currency markets. Probably start with here Euro USD, which hasn't seen tremendous and high volatility. And I have to say, even if we are now dropping lower, which is, by the way, also showing, especially when looking at the US dollar in general, the weakness of the euro, and that I'm not a big fan of the euro right now, and being long the euro. It seems as if now another attempt to attack the current yearly lows around 111 is on the table, especially if this euro skeptic, euro critical right wing if this right-wing bloc, let's say, in the European Union gets a good result in those European elections then taking place next week, over the weekend, which is then potentially euro bearish, and if we break below 111 could trigger further losses, which are then activating not only 110, but I think that we have a good chance then also to see a drop as low as 109, 109.50. On the other hand, I have to say, I am not really confident that such a push lower here will happen before this election, respectively, given the current and to be expected weakness in the US dollar due to this speculation around the Chinese thinking about dumping US treasuries and potentially US dollar weakness, which should be expected then. So I still think that chances are probably even higher the next week then, that the chances are very high that the euro won't see big volatility in the days to come, and that we continue to trade within a range then between 111 and 113, 113.30. In fact, it's a very, very wide range compared to the or in relation to the current low volatility we get to see in the markets, but it also perfectly illustrates it's difficult to say in which direction such a breakout, if it happens at all, which levels to watch there, and also it's perfectly illustrating that it's really unlikely to get to see such a break in such a low volatile market environment we're currently in, even though the current drop lower in the euro, driven especially by those comments from the Italian government and sharply attacking then also Brussels, is perfectly illustrating that currently you don't really want to be aggressively long the euro, in my opinion. But the currency, which is definitely of in my opinion, the highest interest when it comes to the US dollar right now, and when you're skeptic about the developments in the US dollar, given the facts around the trade war and the Chinese here, as in my opinion, definitely dollar JPY. So we failed to significantly break above 111 already several weeks ago, in fact at the end of April, and now we took on momentum on the downside, and we broke below 110 and stabilized there. So we can definitely consider this as to be a sustainable break. And the current retest of 110, I'm not making it back above that level. The fact that 109.80 around here has been the March low, and we broke below that level, is activating lower targets being found then around 108.50 on the downside, and probably even lower than that. So then we are going for a test of 104.70 on the downside, potentially, if we break lower and take on further momentum on the downside. And this is especially true if the US dollar is sold, and especially if it's sold due to further escalation of trade war between the US and China, because risk aversion hitting the markets is usually a first reason to be bid the JPY due to the fact, or to expect the JPY being bid, due to the fact that usually you use the JPY to fund carry trades, and which means you're looking for a low yield, zero yields finance vehicle, let's say, and then you buy higher yielding assets. In this case, if risk off hits the markets, then you usually get an unwind of this carry trade, which means natural capital flows back into the JPY in this case, and this usually also is potentially driving dollar JPY lower. Even though we have to consider the fact then, what we know is that there's usually a negative correlation between I'm sorry, no, not a negative correlation, but the positive one. Positive correlation between dollar JPY and a 10-year US Treasury yields. So let me just probably show you a chart. It's a German one. It's one from my first book I published in 2014 already. So don't be surprised now to see only a time span from, I think, 2010, 2009, 2010 till 2014. In fact, it's 2003. So it's a German chart, but this correlation hasn't changed. So what you get to see here in orange is 10-year US Treasury yields, while you have in gray dollar JPY. And you can clearly see that there is a positive correlation of these two. And what's interesting now is the following. Usually you would argue, if the Chinese really dump treasuries, isn't it then the case, due to the negative correlation of yields and treasury notes, that a drop in prices usually shoots yields higher, and then naturally results, based on this correlation, in dollar JPY pushing higher, since yields are expected to push higher. So the orange line should go higher, and then usually the gray line should go higher too. Yeah, usually you would expect this. On the other hand, you also have to remember that US Treasuries are a safe haven, considered to be a safe haven, which means there's already speculations now going on, which say, well, if the Chinese really dump treasuries, you can find enough buyers of those bonds, since they see another potential escalation of the trade war and a real potential financial war breaking out in this case. So it would be a very sharp and a step which no one really saw coming, because you can expect also the Chinese to suffer then, but which would perfectly show that they are obviously they are obviously willing to attack back no matter what. And so with this in mind, usually you would expect then market participants to aggressively step up as buyers and to save their exposure, respectively buy something they well know and which has served as a safe haven in times of high volatility and risk aversion. And that said, it's not sad that there would be such a huge spike higher in yields, but that the yields in fact dropped due to the high demand for US Treasury yields then hitting. And so this is definitely something which is interesting from especially fundamental perspective. We probably should, especially when looking at this shorter time span, we should especially look here at the technical side, the price action side, and we can definitely spot that we broke below a crucial support, and we can consider this break lower to be a sustainable break. And so dollar JPY is most likely a very good short candidate then over the next days, especially if we are breaking below 109 again. Then 108.50 is the next target, and even lower than here, the long-term target, mid-term to long-term target, can, in my opinion, be found around the flash crash lows from January. But this only if such a trade war escalation takes place. On the other hand, as long as the market stays calm and no further escalation is presented here, we shouldn't expect a very aggressive drop to happen. Nevertheless, you should have this in mind. And then when looking at dollar JPY, definitely all the time makes sense to have a look here at gold too, due to the low yield currency JPY, and also here the precious metal gold or yellow metal not getting yields here. So the pricing behavior is very similar. Respectively, we can say it's a negative correlation. Usually, if you get to see demand for the JPY, you usually should get to see demand for gold too, especially when it comes or goes hand in hand with risk aversion. And what you can also say, nevertheless, is here last week we've seen the push higher, even though the push higher wasn't really, it's not sad that it should have been expected. Let's put it that way. Why do I say that? Well, the fact that there was another step taken in regards to the escalation of the trade war resulted not only in a potential risk off, which is the most likely driver higher here in gold and pushing us at least back towards 1,300 USD, but it's also one thing worth mentioning here. It also resulted in market participants dumping Chinese yuan here, where respectively the Chinese authorities then to dump the Chinese yuan respectively to weaken their currency, with the idea of countering any negative effects import tariffs could have then on their business and on their economy in general. And so with this in mind, and knowing that there was at least some kind of positive correlation between the Chinese yuan and gold in the past, it's not given all the time, but sometimes you can definitely see it. And by the way, and this is probably interesting for crypto traders also, you get to see the same right now with Bitcoin. So there's a high positive correlation between Bitcoin and the dollar yuan. And you can say, even though I'm not a big crypto fan, respectively, fan in terms of I'm not trading actively cryptos, but what I can say is that as long as the Chinese yuan keeps on weakening, and in this regard, look at the dollar yuan and the threshold around 7. As long as we can continue the yuan to weaken and probably dollar yuan to take out 7 on the upside, Bitcoin should remain bid, and I still see further gains then, and probably also retest and push back towards 10,000 in this context. So that's probably something interesting for some crypto traders then. But let's come back to gold. It's very difficult to right now see a clear advantage in this asset. So all in all, I have to say, from a pure technical standpoint, this head shoulder formation, we made a topic for several weeks now. So here's the shoulder, the left shoulder, there's the head, there's the right shoulder, and then we saw the break of this neckline here in blue and the potential retest here, and then we said everything now which pushes us below 1,266 USD is potentially bearish, and forthrighting the sequence then here resulting out of this head shoulder formation, activating a target on the downside around 1,230, 1,235 USD per ounce. So now the thing is, with these developments around the trade war with the US and China, risk aversion hitting the markets, we've seen a push back above this neckline, even though it's so far we haven't taken out the right shoulder here, which means the formation is still active as long as we trade below 1,310. Probably some might say as long as we trade below 1,325 USD, but still the picture looks not very promising for short engagements, and this here is now an even better spot to emphasize that I only want to short gold with a drop below 1,266. So if I'm shorting gold only if we break below 1,266, and then here with a sell stop order. The problem with this is, nevertheless, the projected target of this head shoulder can be found around 1,230, 1,350, 35. So that makes 30 to 35 USD per ounce as a potential reward. And then here, the question is this attractive enough from a risk-reward perspective, or probably shouldn't we be not very keen to trade such a break lower? Because the stop of this trade would be placed then around here at minimum 1,300 around, which makes a risk-reward of 1-to-1, in my opinion, not very, very attractive. So, and that said, gold has some difficulties right now. It's interesting from a pure fundamental perspective. It's interesting from a technical perspective, but from a trading perspective, I'd be a little careful here to be too aggressive, since I don't want to anticipate a break that could then give you the risk reward you need to trade such a formation. But the problem with such a trade is that in the current market environment, you don't want to anticipate gold weakness, since every time, especially right now before the weekend, we could sharply gap higher if any new escalation is given. Especially, let's just assume Chinese really start to dump USTs. I think it's unlikely still. If they do, well, you should expect gold to explode on the upside, in fact, and that would definitely kill any short trade in gold here. So I think it definitely makes sense to wait for confirmation, and unfortunately, this goes hand in hand with an attractive risk reward, which makes gold not the first choice, or at least not from a trading perspective, in my opinion, but probably from an analytical perspective first, and then see if you probably find other better spots to trade gold in. So that's it on gold. Let me just give you an idea here on dollar CAD. By the way, what we can also do is in the morning I had the chance and the pleasure to present my thoughts and the real daily trading ideas. And we can have a look then at Euro JPY, and if the trade is developing fine for the setup itself, please have a look at the webinar. The recording in the YouTube channel from Admiral Markets should be somewhere around here. If you're watching the recording, so right now, not for the attendees in the webinar, live webinar, but the recording, if you're watching the recording, then somewhere you should probably see the real daily trading ideas. Why do I mention this? You can see the trade here so far. It's taking on momentum. Let's see whether really there will be further momentum taken, especially with risk off in the afternoon. But before we have a look at the chart from Euro JPY and an hourly chart, let's have a look here at dollar CAD. Things are getting very, very interesting right now. Why is that? Well, so it's time to look at the level around 135 again. So we are very close to this level right now. And why is that of interest right now? Well, it's because of what I already said here. It's from Wednesday, this tweet regarding the aluminium and the steel tariffs here, and the potential positive if they are lifted or delayed or not even imposed at all, then we have a very good chance to see usually the Canadian dollar being aggressively bid. Now the interesting thing is, nevertheless, it's an old story already. So somehow all market participants somehow seem to expect this kind of action being taken then, and which means nothing more than if this is not happening before the weekend. Some market participants are probably caught on the wrong foot, and probably this is already showing here some of these bets which were taken on Wednesday. Let me just go to the 50-minute chart here and have a look here. So that's 2 days ago. So it's the 15th of May. As you can see here, that was especially in the afternoon then. There was this sharper drop and it accelerated then also in the first hours of trading yesterday. And then we saw this sharp reversal here. And now we're going for 135 again. And what's interesting of this price action, given this developments around the tariffs and aluminum and then steel tariffs of the steel and aluminum potentially being lifted. What's interesting is that market participants probably expected action being taken quickly on this one. So now we are going again for 135, and that's sad, and especially the significance of this region. Probably we're about to see a short squeeze then into the weekly close, and which would quickly activate the target around 36.70. So especially for FX traders, the region around 135 seems to be of higher interest here on the upside, and especially now when we are about to let's call it enter the red zone here. So it's we are really close to get to see probably a cascade then of buyers stepping into the market and aggressively pushing dollar CAD higher here in this context. And what's also of interest, by the way, is very interesting. Therefore, I already all the time have a look here at the DAX, by the way. So we continue to drop. So we continue to give back gains from yesterday, and in my opinion, even though I'm still bullish, so don't get me wrong, it's nothing changed here. I said, well, if we are not triggering long against 200, 220, well, we're probably triggering along a little lower than around 130, and as long as we trade above 12,000, everything seems to be fine. Still, this drop lower here is something I I watch with I'm very careful. I could imagine this probably to accelerate if things turn out bad here for a green weekly close after Trump hasn't said something in regards to the delay of auto tariffs. And on top of that, there's also something worth mentioning, and you will see what this has to do with dollar CAD in a few. But first of all, there was yesterday something which is really also well, it's brutal. It's scary what's happening there with China's Huawei and 70 affiliates placed on U.S. trade blacklist. What does this mean? Well, it's they are placed on the so-called entity list, and that's a move that bans the telecom giant, so Huawei in this case, from buying parts and components from U.S. companies without U.S. government approval, which they surely won't get in the current environment. And the question which arises surely here is, I mean, Huawei is a giant. The same is true for Apple. So will the Chinese take any steps against Apple in the Chinese markets, which is a big market for Apple, if I'm not mistaken? If that is happening, well, we can, or what we all know is that Apple has a big chunk of the action and the big market cap when it comes to the Nasdaq 100, or in general the U.S. equity markets, which means a sharper decline and Apple shares could easily trigger a sell-off on a broad scale and on a broad front in the equity markets into the weekly close. So this is also something worth watching at. And what has this to do with dollar CAD? Well, there's a chance to draw positive correlation between the dollar CAD and the VIX, so the volatility indices. Usually, if volatility picks up, you usually see dollar CAD picking up, one or the other way around. And especially when looking at 135 in this regards and having this potential volatility spike. But by the way, we all know that the VIX market participants are still very short volatility right now. There's a good chance that probably such a spike in volatility is pushing dollar CAD then aggressively higher above 35 here. Yeah, and that's it, by the way. Therefore, now let's close the circle here. That would be fantastic, let's say, when it comes to the trade setup I just presented in the real-time daily trading ideas, because if we get to see such a push in volatility, we should expect JPY to strengthen. Current market environment, you don't want to be long the euro, so that would definitely play in our hands here with this setup. And yeah, probably the key level to watch on the downside is around 122. It's a round number. If we break below that level, further losses are probably likely. And then let's see whether we can make it at least towards the take profit here on the downside, which is currently placed at 121.54. So, and that's it from my end. I hope you enjoyed the webinar, and I wish you all the best. A nice weekend. Enjoy yourself. If you have any questions, please feel free to ask them also now after you listen to the webinar. Send them over to the service desk from Admiral Markets. They will forward it to me, and I'm more than happy to answer these questions then. And yeah, that's it from my end. So have a nice weekend. All the best from Berlin, Germany, and talk to you again next week in the weekly market outlook. That's it from my end. So take care, see you, and bye-bye.